Thank you for coming back for the session after lunch. I always dread doing these sessions because people either have carbohydrate, what is it, come down from it. But and for those of you who are joining virtually, thank you very much for joining us. So my name is Yvonne Kunihira-Davidson. I lead the tax solutions business within EMEA for S&P Global. I think most of you have heard of S&P Global, and our division I sit in is Market Intelligence, which is an old financial services division. So I've been practicing in this area of tax since I was 5, about 20 years, right? At the start, I fell into it when I was trained as a chartered accountant at PwC, and I got involved in the US information withholding regime through the qualified intermediary regime at the time, and it's spiraled from there into FATCA and CRS, CARF, etc. I'm delighted to be joined by Lauren and Maarten, who will give both a perspective from industry in the case of Maarten, and Lauren is here in a personal capacity, but she is the head of the tax transparency unit at Treasury. So Lauren, if you could introduce yourself first, and then we'll hand over to Maarten.
Yes, well, look, thanks so much for having me. So as Yvonne said, I'm Lauren Griffin, so I head up the unit in the Treasury responsible for tax transparency and sit kind of more broadly in the wider business and international tax area of the Treasury. Prior to this, I've worked on kind of a variety of different economic policy areas for the UK government, having led trade negotiations as well as tax negotiations for the government, worked in financial services and labour market economics, so a wide spread, but yes, currently working on tax transparency and have been the UK delegate in the Working Party 10, negotiating the CARF and the CRS amendments.
Thank you, Yvonne. Thank you, Lauren. Good afternoon, it's Maarten Hoeven here. I do live in Edinburgh now, so if my Scottish accent is too much for you, just let me know and I can go on to Dutch to help you out. So I've worked in the Big Four for 12 years or so before moving into industry. Different challenge, and I think we've all heard already about transparency. Simon York has already mentioned the importance of the introduction of the CRS regime, for example. We've heard Prem Sikka talk about transparency from various different topics or angles, not just from a tax perspective, but they're all aligned, of course. And maybe in short introduction to my current role is within the industry for abrdn. Most of you probably have seen something in the press about us, good or bad. Some say all press is good coverage, but I think our CEO disagrees. And I think ultimately it's also on trust that we've discussed before. And I think if I look back over a couple of the regimes, I think a lot of it is about trust. So the QI regime was introduced because of a lack of trust, that people were claiming tax-free benefits right, left, and center, and that didn't go down as well as it should have done. And then you get FATCA because there was some misuse of the QI regime. It's also about trust. And then we get the common reporting standard is also about, to some extent, trust. Of course, that tax authorities didn't receive the right information to validate people's tax returns and all that. So the trust and transparency is been around for a long time, and I think it will probably continue to be around for us. But anyway, that's probably enough for an introduction. Thank you.
Great, thank you so much. Okay, can you hear me? Yeah. I says when we were preparing for this panel, we thought we could probably spend the whole day talking about tax transparency, the benefits, the challenges, which regimes to be focused on. But bearing in mind the audience that you're from asset management and there are a few banks here, we thought that we'd focus on the tax transparency initiatives that are more relevant in our mind, which would be around the common reporting standard, exchange of information, automatic information exchange. As you know, on the 10th of October, the OECD published amendments to CRS that Lauren mentioned in her introductory remarks, and also a new tax transparency standard for crypto assets called the Crypto Assets Reporting Framework. I'd just like to know by a show of hands, how many of you here, your firms are already offer crypto or investing in crypto or are thinking of offering crypto as an asset class? Okay, not many. Okay, so that means that it's more nice to have, but I think it's helpful for many of you to understand some of the parallel, commonalities and differences in scope between CARF and CRS. Okay, so tax transparency. What's tax transparency about? So tax transparency is about putting an end to bank secrecy and tax evasion through global tax cooperation. So perhaps we just take a few minutes to go back in time, because I think that's very helpful in understanding where we are today. So Paradise Papers, anyone remember those? Panama leaks, anyone remember those? Right? Now, I didn't realize that one of those leaks was like more than 10 years ago. It was just like yesterday. But the data leaks have shown that tax evasion is not an isolated financial crime. And I think that's at the heart of why governments are really stepping up their efforts in this regard. And the leaks reveal that the use of companies and trusts to hide beneficial ownership of assets, and also highlighted how tax transparency can help in preventing tax evasion, corruption, and other related activities. Now, this morning, we heard Lord Prem Sikka talk, right? It's interesting that he said that he's a co-founder of the Tax Justice Network. So the Tax Justice Network have what they call ABCs. Our current health secretary has the ABCD agenda. So the Tax Justice Network has put out for tax authorities an ABC that they think they should be doing. The A is around automatic exchange of information, which we know under the CRS. B is around beneficial ownership registers. Yeah, and we know that there's a framework that the OECD put out a while ago. And then C, this kind of country by country reporting, which is linked to BEPS Action Plan 13, so that companies can report the real profits they make in a jurisdiction, right? We then have the OECD is central, and we have the Oslo Dialogue, which was launched in 2011. And if you think about the OECD and you talk about the Working Party 10, I think Working Party 10, according to my research, was probably established in 1971. And historically, we've had exchange of information. And it's only with the Global Forum was reformed in its current form in 2009, which was shortly after the UBS case broke, which highlighted the deficiencies in the qualified intermediary regime, which resulted in FATCA, as we know it. And we know that CRS is effectively an extension of FATCA, saying, well, if you as financial institutions are going to provide this information about foreign-owned accounts belonging to US taxpayers, then surely you can provide the same information about the foreign accounts owned by non-tax residents of your jurisdiction. And so you have that, but I mean, Lauren, I'll invite you to talk about some of the challenges, but just again, I just want to just highlight how things have changed over the period. So the OECD also came up with the Multilateral Convention on Mutual Administrative Assistance in Tax Matters, and that allows all relevant jurisdictions to exchange information in tax matters in line with the most up-to-date international standards. I think it's quite important for you to understand why being a signatory to the MCAA is so important and how it then accelerates some of the changes. So like if you think about CRS 2.0, which we're going to come to, how long, that's not going to be years in coming into fruition, because most of the CRS participating jurisdictions are exchanging under the MCAA. And there's more than 130 jurisdictions who participate in this convention, which covers, I think, 97% of the world's GDP. Interestingly, under the MCAA, the bilateral exchange relationships have grown from 2,600 in 2017, 2018, 4,500, 2019, 6,100, and now in 2020, 7,000. The source of all my figures is the OECD website, so you can verify that there. Now, when you come to AEOI, and we're going to come to the CRS, and just how successful do tax authorities think the CRS has been? So we have 2018 information on 47 million financial accounts with a value of 4.9 trillion euro was exchanged. 2019, that went up to 84 million financial accounts with a value of 10 trillion euros. And the 2021 information on 111 million financial accounts with a total value of 11 trillion. And as a result of the CRS and voluntary disclosure programs associated, linked to it, over 107 billion euros in additional tax revenues have been generated. So I think if anyone thinks tax transparency is dead or is dying, I think these figures show otherwise. But what's also interesting is there's been a shift in where certain behavior of certain investors in terms of where they keep their financial assets, in terms of a reduction of at least 22% in cross-border owned financial assets. So with that, that just sets the background. And I'd like Lauren to, if you can just give us the policy perspective about why tax transparency is important to governments, and also, why governments favor automatic exchange of information. We also have exchange of information. If you can just share some thoughts about that.
Absolutely. Well, thanks for that fantastic introduction. I think we may end up saying some of the same facts, but I think that's good because it shows that they're very important and that we should take note of them. So look, as everyone said, so tax transparency at its core is all about how we put an end to bank secrecy and tax evasion through, I guess, what we talk about as global tax cooperation. But when we talk global tax cooperation, really what we're talking about is exchange of information. And that's, why we hear all of the different kind of words or verbiage but at the heart, it's all about exchanging this tax information. And so, this obviously kind of started initially as exchange of information upon request. And of course, that was kind of covered in the multilateral convention, the MAC, as we in the policy world like to call it, because we like to shorten words to make them more punchy. And then, of course, there was this move towards automatic exchange, which was really facilitated by the landmark global standard, the Common Reporting Standard, the CRS, which I'm sure everyone in this room is aware of. And I guess the CRS really revolutionized tax transparency because it required financial institutions to report information on taxpayers' offshore income and financial assets, which jurisdictions across the world then automatically exchange to help identify non-compliance. And so to bring that to life, in the most recent Global Forum report, the Global Forum, of course, being the OECD body that's in charge of the implementation of all of this, outlined that there are 144 jurisdictions that are participating in the MAC, as I said, the multilateral instrument that governs exchanges. That's a huge coverage across the world, right? And that just shows just how extensive that this is. And Yvonne also gave us some really fantastic stats on, how much revenue this has generated. And actually, one of the most interesting figures when I was looking at it is, obviously we can talk about the 112 billion of additional revenues that's come in, but actually 3 billion euros of these additional tax revenues has been linked directly to the use of the information exchanged. And that just shows just how much tax authorities across the world are actually using this. So, of course, more recently, the OECD have been making amendments to the CRS and developing a new crypto asset reporting framework, what I'll now call the CARF, in yet another reductive way of saying the same thing. And I've been fortunate enough over the last few years to be involved in those international discussions. And I think just maybe to give a little bit of a flavour about why we've been doing this. I mean, I think the OECD has been driving these initiatives in response to innovation in the financial sector, none of which will be new to you, but I think obviously has been, really at the forefront of the OECD's mind in taking these initiatives forward. So if I maybe concentrate first on the changes to the CRS. So, new financial assets, products and intermediaries have been brought within the scope of the CRS. And that's because they are potential alternatives to traditional financial products. So maybe to be specific here, we're talking about particular e-money products, central bank digital currencies, and of course, indirect investments in crypto assets through, for example, derivatives or investment vehicles. And there has actually been some additional changes to improve CRS reporting. So, for example, identifying whether an account is pre-existing or new. And this is all about how the information is made more useful. Then, of course, alongside the CRS has come the CARF, which has been about delivering transparency in crypto assets, sitting, I think, very neatly alongside these changes that we heard in terms of bringing in e-money and CBDCs. So now we're talking about crypto assets as well. And of course, there has been in the financial sector a rapid adoption of crypto assets for a wide range of investment and financial uses. And unlike traditional financial products, I guess crypto assets can be transferred and held without the intervention of traditional financial intermediaries. So I suppose without the intervention of a lot of you in the room and the people kind of listening in. And without any central administrator having full visibility of the transactions carried out or the crypto asset holdings. And instead, what we've seen is this kind of new, I guess, set of intermediaries and service providers, such as crypto asset exchanges or wallet providers, many of whom I guess are currently unregulated in terms of both financial services regulation, but of course, tax transparency frameworks. And this actually means that, of course, these are not comprehensively covered by the CRS, increasing, the potential likelihood for tax evasion. And so, this is why the OECD has moved forward with this. And so what I guess the kind of current, if I was to summarize the sort of the current reason why a lot of this is happening and a lot of these changes have been made is about responding to this innovation in the financial markets and making sure that, if we're talking about an end to financial secrecy, we're not kind of imposing limits by not following this innovation. So that's really been at the heart of the OECD initiatives. And so, of course, the OECD did publish these frameworks on Monday. And if you fancy a really long and legalistic read, you can go and find them on the OECD website. But there's a really great pithy introduction, which sort of sets out a little bit of what I've been saying. And so in terms of what next, well, of course, there continues to be technical discussions on this. There's some kind of key building blocks yet to be developed, such as, for example, the underpinning multilateral competent authority agreements. So being part of the legal mechanism of how different countries exchange all of this. The other thing I did want to draw out as well, which may be a bit less relevant to this audience, but might be worth noting, of course, is that alongside these discussions on the new frameworks, the OECD have also been leading the implementation of a number of other frameworks. So the first is the mandatory disclosure rules, which of course cover CRS avoidance and opaque offshore structures, which is about how we deal with the circumvention of all these tax transparency rules. And then, of course, the other sort of big implementation file that's been going through is the model reporting rule for digital platforms, which is all about getting greater visibility over the income of taxpayers who use digital platforms to sell goods or services, helping to ensure that all taxable income is declared. And I just kind of mentioned these to kind of show that there is sort of a, we've talked about exchange on request to automatic exchange, but actually there's been a whole kind of bunch of automatic exchange initiatives that have been going on since the introduction of the CRS. And these are sort of two that I guess build on that. So in terms of the UK, so we of course have a new government, so it wouldn't be appropriate for me to discuss the sort of UK government's forward plans. But of course, historically, we have been a global leader in tax transparency. We were fundamental in driving the creation of the CRS, and then we're one of the early adopters of the CRS, of course. So I'll be in listening mode today and really interested to hear what my fellow panelists have to say about all of this, particularly I think given the publications this week.
Thank you. Maarten?
Thanks, Lauren. That was a good whistle-stop tour to my mind to introduce me. I guess on the numbers, the cynic would say, of course, we're facing extreme inflation. So actually, maybe the numbers should have been higher, but that's just an observation. In terms of the development, so maybe to set the scene, I seemed that I was the only one who actually put his hand up for saying that we're involved in crypto.
No,
so
maybe
there was one other.
Yeah.
Sorry. Anyway, I guess a minority in terms of the audience at the moment, or maybe they're unwilling to show. But maybe worth to say that. So we as in abrdn has not personally my money, but have taken a stake in a company called RCAX. I'm not sure exactly how to pronounce that. In Dutch, we are GAX, but that's probably not the way to do it. But they're the first firm to get FCA approval to set up a digital currency platform, which is meant to launch later this year. So it's not that we're immediately launching products, but we're involved in it and we're enabling, I guess, future investment through that platform. So that's I guess how it gets in, and we do have a number of funds that actually invest in crypto currency or products, I should say. So that's how we get involved through that. But in terms of the actual day-to-day work, that doesn't really impact us just yet. So maybe to set the scene in terms of the CRS amendments, of course, we as an organization, of course, we fully support the tax transparency agenda, and we work with governments around the world, and it's no day goes by or we get another request from Hong Kong or Luxembourg or HMRC for that matter, about missing tins or inquiries about missing information or particular things that they would like to know more about. Plus, of course, we have our investors angle as well, that our investors contact us to say, oh, we've received this letter from HMRC. Is this a phishing expedition or is this actually a genuine request? So we get from all angles, I guess we get involved, and to some extent that's good. And I think what with CRS, the introduction in fact, especially, there's been a lot of lack of clarity, I'd say. That I mean the self-certification forms, for example, that's what it's all about really. QI, in fact, CRS is about identifying tax residency, right? So you complete a form, and that's the beloved or the hated, whichever one, W8, for example. We still get them back, and the number of times that they're not correct is still gobsmacking at times. So there's still an education to be undertaken, I think, there.
So just on that point, Maarten. So the US has the standardized. They introduced those standardized forms like in I think 2001, right? So you have the W8 forms. At least every institution and the investors get used to filling out the same type of form. They may not fill it out correctly, but then at least they're used to that. But with CRS, we don't have a standard self-certification form. We have an OECD, I think, our working group, OECD Business Advisory Working Group, proposed a pro forma, but, it's not widely adopted per se. So how do you deal with that challenge across, because Aberdeen, you've also acquired a lot of businesses that were using different forms?
Yeah, no, that's a good question, and I think it's the typical tax answer would be it depends. So we'd like to think that we can use a standardized form that we have developed internally, rather than because we work with so many different counterparts, they all have their own form. And of course, to fit in all their forms would take, I could spend the rest of my days probably filling out forms, or we could do, not necessarily always me, but we could do that for a long time. So what we try and do is just have our own standardized form, and we issue that. And some are receptive and some are not. Not mentioning any names, of course, but it seems that certain ones are reluctant to accept it because their risk team won't accept it. So that's, I would say, a challenge. Yeah, I don't see the benefit yet in that, but the point is that there's still a lot of activity, to my mind, is some would say paper pushing, to document, and sometimes it goes way beyond what is reasonable. So I think the number of requests you get, it's first it starts with W8, and then you get follow-ups to say, have you actually submitted your FACA reporting? Well, since when are you a tax authority? But you do get those questions, so it's still ongoing. Some go way further than others. Let's put it that way. I think, and in terms of the recently announced CRS amendments, I think, yeah, again, we've heard during the OECD discussions, I think, especially the Finnish tax authorities were saying that they, because of their language, it's still, they get a lot of information that is not particularly helpful. I think it was Simon who also mentioned earlier that actually the data is great and we do use it, but to go to the lower level of detail, we still need more. And I think that's what's behind the CRS amendment. So what does it mean for us as an organization? It means quite a lot, actually, because it means all our onboarding processes need to be changed to capture this information going forward. So what does that mean? That means you get forums, mandatory change forums, for example. I mentioned that last week. So it goes through that process. You get all kinds of stakeholders involved, and they won't be happy because oh no, we don't want to do that. Who's going to pay for that? So that there will be a lot of challenges along the lines, and I think also we can do it internally. A lot of these obligations have been outsourced to third parties, luckily, so that they can take the brunt for that one. But of course, and then the second point is we'll get our investors. They'll say, why am I needing to do this? I've already sent you this before. Why do I now need to present you with more information? What good is that? So, and I think the challenge has been for the industry anyway, that there has been a lack of responsiveness to certain self-certification requests. We've had quite a lot of people who just said, no, we're not doing it. We don't understand it, and just shy away. Equally, I think the OTS has been clear that what tends to happen, and we have that too, that people invest into products for a longer term, right? say you invest in something and you're not interested for the next 20 years because you're just paying in, you might move address, but you're not taking any benefit yet. So in 20 years time, you might say, okay, now I'll let them know where my address is. But then of course, in the meantime, we get the IRS, we get HMRC saying, oh, you don't have a TIN. Well, what's going on? Why can't you get it? Anyway, I'll stop there.
Yeah, that just talk about if you look at documentation, due diligence, because that's really the heart of it, right? This is tax-driven KYC. Part of from at S&P Global, we also we have our tax solutions business. We license technology, so our client for due diligence and reporting, and several of our clients, they face this challenge of, especially when you're dealing with clients online, people don't feel the need. If I've changed my address, I'm dealing with you online. You're never going to send. I've opted out of paper communication. So why do I need to tell you that I've moved? Either in country or even like if you're dealing with, within the EU, why do I have to tell you I've moved in the EU anyway? Because in any event, most countries have a double tax treaty and etc. So that's a challenge there. But I think also, Lauren, it comes when you say it's all very well, organizations have had to change, gone through huge projects, like to get ready for FATCA, to get ready for CRS. Now with these CRS 2.0, it's interesting that there's no timeline mentioned as to when you expect these amendments to take effect. What is the thinking at WP10 level with respect to timeline?
Yeah, so I mean, I think obviously it's a difficult one for me to comment on. I think what the OECD have kind of said publicly, at least, is that they have, I suppose, presented this all to the G20.
Yeah.
And I think it will be really interesting to see what comes out of the G20 discussions and the finance minister discussions. But I think that, look, I think if I look historically, at least, how we've engaged with the business community and we've thought about all of this, I think certainly I hope this is all your reflections, have been very mindful that it takes time to build these systems. I know businesses often talk to me about needing 18 months, for example, following seeing regulations to do that. And so yes, no kind of set timelines that I can confirm at the moment, but I suppose just an awareness of that, and that I guess the next step in the process, I think, on all of this and on the adoption for the OECD is very much that's with the G20 meetings happening.
Right. So for all of you who don't know, the G20 meetings are happening this week. So maybe we'll get a communique by the end of the month. I don't know if they typically issue, or they issue one at the end of after their meetings, for indication of that. But I guess that something else. Is there a possibility that, for example, the CARF may go live before the CRS amendments, or is the intention that they go live at the same time?
Sadly, I fear going to give a very similar answer of it's all continues to be under discussion at the moment. But I will say that if you look at the documents that have come out, I think one of the things that I know WP10 have spent a lot of time discussing is that there is an interaction between the firms that are doing some of the innovative products that we've brought into the scope of the CRS, and also with crypto assets. And I guess just reading the news, I suppose I'm aware of increasing asset management firms that have been kind of taking stakes or whatever, and you were talking about this earlier, Maarten, in crypto platforms and exchanges and those sorts of things. And so a lot of thought has gone into how do the two frameworks work together. There's mechanisms, for example, like about gross proceeds switch offs and all those sorts of things, and making the due diligence provisions as aligned as possible. So probably not a direct answer to your question, but maybe just a sort of reflection that I think there has been a lot of time spent in discussions thinking about how these two work together, given there probably will be certain actors that are hit by both.
Okay, and just one more before we come back to report some of the challenges on reporting, Maarten. Lauren, in terms of, it was interesting when for those of you, the document Lauren was saying, if you need to read it, this is it. If you're old school like me and you print it out, it's about 100 and something pages. There wasn't anything in there that's unlike the CRS, and there's always a note of CRS participating jurisdictions, and it says the US deems itself to participate by virtue of FATCA exchanges. I didn't notice anything about that on the CARF. So should we take it as, and I know that the US wasn't at the table because when we had the various consultation meetings, should we take it that the US intending to participate in CARF?
Sure, I would not want to speak for US colleagues. I mean, I guess just to reflect on the CRS and the FATCA documentation, of course, there is a very clear and historic link between the two of them. Of course, the CARF is not the same initiative as the CRS, although the two, it is my hope, as I said, that the two will work together. And so, look, I think all of this remains to be discussed.
Yeah, okay, thank you. But for those of you who want, I mean, the US was quite, when we were involved in some of the meetings that we were invited to as part of the business advisory group, the US were active participants in the group, so we'll see. But one of the things that you should know is if you want to have perhaps an indicator of what the CARF might look like in more detail, is to watch out for when the IRS release their information report, the detailed regulations on crypto reporting, because the US, that's already been passed in law in the US, and we're waiting Treasury regulations around that. Or something that's interesting there in terms of a change between existing US information reporting and that will affect the crypto asset service providers, is that there's a requirement for a validated TIN for the crypto asset service providers, whereas today it's considered best practice for financial institutions to validate the TIN. But there, of course, there is a mechanism for you to do that if you're a US financial institution, which outside the US is lacking for the most part for financial institutions to just like have an API and validate that the TIN, because I think Maarten, maybe that's something in terms of a challenge is, yes, the OECD has published TIN formats, which kind of work, but you still get queries around is it that it's missing TIN or it's an incorrect TIN, correct?
Yeah, we do get various challenges from authorities across the globe about that. And again, I think it links in to some extent, why there's still amendments being introduced, because the data is helpful, but it's not always helpful to the level of detail that sometimes tax authorities need to target specific taxpayers. And that's probably where we're going with that. So in terms of what happens with the challenges on TINs, yes, ultimately, unfortunately, we are also reliant on our investors. I mean, if they don't respond, or if they don't, take due care, whichever you may want to put it, then of course there's not much more we can do. And to some extent, maybe for those of you probably who picked this up, but I was talking about errors on forms and all that, but that's also, I think there's a journey for technology, right? So if you have technological solutions that we're working on, then some of these errors should go away, because if you build in already the right, at least numbers, sequence, etc. Exactly. Then at least you have that, and then you're limiting, I guess, the number of challenges that you might find.
Right.
But ultimately, yeah, we rely on data. That's not to blame our investors all the time. That's not fair. It's also, I think, sometimes it's our own data that needs to be upgraded and updated. So there's various bits there, and that there's been a theme that has been discussed already in terms of the data, quality of data, and of course, it's also of no use to tax authorities to get data that isn't accurate, because they can't use it in any way. And maybe actually, I wonder, it's not the right question for Lauren, but in terms of how far can they take data to taxpayers if they're not confident that the data is actually correct? And it's not, I'm asking you necessarily for, but you can comment, of course, if you feel free. But that's another thing, of course. It's the confidence in the data being accurate, and then be able to take it forward. So
yeah, I guess part of also that I'd say when you look at the information under CRS, and probably will be the same under CARF, is that financial institutions will report information they have from me, but they don't give me a copy. Unlike in the US information reporting regime, where generally speaking, if I was onshore in the US, I would receive a copy of my 1042S, or if I was a US person, 1099. Has there been discussion about letting copies of the information that is reported by the financial institution to the tax authority, also a copy to be given to the account holder?
So, I mean, in terms of whether that's been discussed at the OECD Working Party 10, I mean, not in my memory, although I should be clear that, you know, I've only been in post for a couple of years, so I wouldn't, you know, want to discount the possibility it has. But I guess, of course, you know, if this is a big concern as well, I'm sure that, you know, my colleagues in HMRC as well would, you know, be interested to kind of hear and understand that. But yes, I think that's probably.
So perhaps then I guess a call for you in the audience. I'm conscious we have only 3 minutes left, 2 minutes according to my watch now, is for you to get into, you know, please familiarize yourselves with these standards and get involved in, you know, the lobbying efforts of UK finance and, you know, other industry bodies, so that you get a solution, you know, that works for you, for industry. No one has as much money as we had when FATCA was introduced for all those projects, unfortunately for the advisors, but that's where we are. In terms of, I know we only have a couple of minutes left. Are there any questions from the audience to others? Yes, please.
Yeah, I too.
Please.
One, obviously, around the US and just basic FATCA reciprocity. Any chance of that anytime soon? It's a rhetorical question.
Well, well, I guess they continue to expand the list of countries that they say they are, you know, they're exchanging certain information.
But they don't collect the information.
No, they collect what they have expanded is the list of countries that.
Yeah, but they don't have any kind of look through. So it's
no, they don't look through.
It's
not the same. But what they do collect, what financial institutions today do report on a 1042S, in terms of that they've expanded the list of countries that can be exchange.
So that naturally follows on to my follow-up, which is a more interesting question. You know, the Senate Finance Committee, this Wyden report, I don't know how familiar you are with that came out in August, identified, you know, they discovered, inverted commas, the loophole, which I think, you know, others advised, myself included, have advised on, existed in 2014, about the concept of micro FIs, small FIs that don't get reported at all.
Yeah.
I mean, I think the point Simon York made earlier, you know, actually, if you're a world-class tax evader, you know, your data is not in the CRS data that's being transferred, no, that's being sent over the world, right? It's sort of, it's missing from it. It's exactly the point you made. I mean, was anything done in Working Party 10 around sort of micro FIs and looking through those? I mean, it's kind of always astonished me that the design of the schema in the first place allowed for this. It's crazy. I mean, what you think what gave rise to FATCA? I mean, before Paradise Papers, before, you know, Panama Papers, anything else like that. It's quite funny because what gave us was, you know, Americans hiding behind institutions, or sorry, Americans hiding behind shell companies in warm and sunny jurisdictions. So how, you know, we haven't defeated that. No, the Senate Finance Report, 2.8 billion, the largest ever tax evasion in the US, was just something that was, you know, in fact, didn't solve for. So it was a bit of a rant, but I don't think there's a question there. It's just a question. My question is around the reform of, you know, should micro FIs be reformed? I mean, it's interesting because in my observation, I cover a European jurisdiction. CRS is not common, unfortunately. The implementation in different jurisdictions, and a lot of jurisdictions have specific guidance around micro FIs that say, no, you should, their passive NFEs report the controlling persons, disregard them. But if they certify that they are FIs, we as a bank say, yep, you're an FI, and we agree, because them's the rules.
Right, and maybe just to add a little flavor to that, many micro FIs, I think it's an interesting term, but a lot of these are private trust companies. And they fall, in the States at least, under the jurisdiction of the state, less so the federal government. And so you have states like South Dakota, Delaware, Nevada, that have recently, over the last several years, passed very strong identity protection laws around trusts and one's ability to get into trusts. South Dakota, by the way, is like impenetrable. So, you know, look to South Dakota as your new offshore jurisdiction to hide money from, I guess. And I'm joking, but like that's really what's kind of happening in certain places of the United States. So,
The red flags as a financial institution, if you're seeing them from those jurisdictions.
So have you got any parting comment? Because now we are 2 minutes over. Can you just give a response and then we'll wrap up?
Yeah, I think yeah, the Brockman case that you refer to, that's what this is about. And yes, of course, that is a challenge. And I think I don't know, it's not an easy answer. I think, you know, that like you like you say, right? You start with QI, that there are certain things around that. That's why FAC is introduced, and then you get GIN, you know, set up as in your intermediary number. That's basically is the holy grail. because that's how basically, yeah, like you say.
CRS has the same issue without the gin, for good measure.
Exactly, and then, but then again, it's also, you know, then how do you police that? So, you know, for we spoke about this actually the other day, that actually from a QI perspective, you won't just get a QI EIN. So if you're a qualified intermediary, you have to go through a rigorous process. There is
Yes.
validation, but actually, and maybe it's a numbers game, maybe it's because of the lack of budget at the time, or and the IRS has been challenged on that, you know, through various Senate committees, TICTA, you know, you can mention them, that they're not spending enough effort to validate. And I'm not saying that, of course, that you know, it's all down to the IRS to sort it all out, because it's still the taxpayers that set it up and to some extent get away with it until it gets found out. But it's difficult. I think it's a difficult balance to
Well, I'd say
strike.
two things just in closing. I mean, this has been great. I wish we had a longer, slightly longer for the panel. But the US, you know, one of the infrastructure acts that was passed this year, last year, actually allocates $80 billion to IRS for enforcement efforts over the next 10 years. The QIT, the Foreign Payments Practice Team, which is the one that's responsible for overseeing the FATCA regime, the QI regime, sit within that division. So I would hope that we should see some change over the year. But the last thing I'd say to you, if you have suspicions that a micro FI institution is not really an FI or is engaged in tax evasion, well, you've got your local AML
No, without doubt.
reporting that you can do, suspicious, you know, reporting and pass it to the government.
I mean, the irony, I mean, don't even sum it, because the design of the rules when that micro FI has a discretionary account and you force them to be an FI, because the way the rules work.
Yeah.
And we have endless debates over clients saying they want to be passive NFE, and no, the rules say you can't be passive NFE because you have a discretionary account with the bank. All the time.
Okay.
And it's also actually interesting to see that tax authorities take different views as well. So we get challenged sometimes if we're an active NFE for certain entities, and equally the other way around as well. So it's also it's not consistent necessarily to say, well, some say you should be an FI, why are you not? And the other way around, and it's the other way around as well. So there's, again, that's the less common.
Yeah.
Sorry,
Thank
Ali.
you very much. Absolutely mindful.
Fortunate today to actually have Antonio. So Antonio, just to plug for you, and I'm sure you're going to be very active on this.
Not on this DAC, because, and a DAC 8 is coming next month, building on CARF, but probably for now we will keep silent, but exchange of information, everything that was discussed today, it's really interesting, and do engage with trade bodies.
I didn't mean to put you on the, on the spot there, but thank you very much. Thanks a lot, guys.